Stop scrolling, pull up your chart, because silver didn't move today. It snapped. Minutes ago, price took the $97.22 ceiling, crushed it, and then did the one thing breakout traders wait months to see. It came back down, kissed $97.22, and held. As I'm recording this, spot has already tagged $98.81, and the market is staring straight at the psychological wall at $100. If you've been waiting for a dip, I'm going to show you, using the 200-period SMA, why that dip window is shrinking by the hour. And if you're already in, I'm going to map the two zones that matter next, $99.40 and then the $110, $120 magnet zone for 2026. The breakout event, $97.22, became the floor. Here's the story in one sentence. Silver converted resistance into support in real time. For weeks, $97.22 acted like a lid. Every rally into that zone met supply, profit takers, shorts leaning in, algorithms fading the move. Today, that lid didn't just break. It got vaporized. And the most important detail is what happened after the break. Price didn't collapse back under the level. Instead, it rotated, tested, and held above $97.22, like it was newly poured concrete. That is the difference between a headline spike and a structural breakout. Spikes leave wicks, breakouts leave floors. So from this moment on, I'm treating $97.22 as the first defense line. If that line holds, the market is not ranging. It is building a launch pad. The next gate, $99.40 before triple digits. Now zoom in. Between $98 and $100, the market gets weird. You'll see fast candles, whip moves, sudden pullbacks, because round numbers attract orders like a magnet. That's why $99.40 matters. It's the last clean hurdle before the market starts printing 100 on screens everywhere. And when that happens, you get two forces at once. Momentum traders chasing, and skeptics forced to reprice their disbelief. So watch the behavior at 99 on or 40. If we punch through and hold above it on strength, the odds shift toward a clean run at $100. If we stall there, you'll likely see a quick shakeout back toward the $97.22, $98 zone, and that would still be bullish as long as the floor survives. Key idea, a pullback is not a failure. A pullback under the floor is. The MACD surge, extreme positive momentum. Now let's talk momentum without getting lost in jargon. On the daily chart, the MACD is in extreme positive territory. What does that mean in plain English? It means acceleration is accelerating. The MACD line is pulling away from the signal line at a steep angle. That widening gap is the market's way of saying buyers aren't just present, they're getting more aggressive. When you see a divergence this wide, it typically shows up when bigger money starts stepping in. Not the first wave, but the second wave. The kind that doesn't care about a 50-cent dip, because they're positioning for a multi-week move. And here's the part people miss. Momentum moves in phases. First, you get the quiet climb, then you get the breakout, then you get the public realization. MACD in this posture suggests we're leaving the breakout phase and entering the realization phase. If you remember the initial 2025 run-up, the character is similar. Once the MACD opened up like this, the market stopped offering comfortable entries. Not impossible, just uncomfortable. The 200-period SMA, why dip hunting is getting expensive now, the metric that settles arguments, the 200-period SMA on the 4-hour chart. Right now, that long-term average is rising around 91.47. Price is trading roughly $7 above it. Technically, yes, that's stretched. Some people will call it parabolic. But parabolic doesn't mean must crash. Parabolic means trend is stronger than your emotions. Here's the rule. As long as price is above the rising 200 SMA, the trend is intact. And as long as we stay above the higher support zone around 93.64, the structure stays clean. So when someone says, I'll just wait for the dip back to the 80s, the 200 SMA answers them with cold math. That dip requires the entire trend to break, not just breathe. Could it happen? Anything can happen. But is it the base case while the 200 SMA is climbing and momentum is expanding? No, and this is why dip hunting is getting expensive. Moving averages chase price higher in strong trends. Your perfect entry becomes a memory. The market doesn't punish you for being cautious, it punishes you for being late. The dollar backdrop. Why the wind is at silver's back. Now we look at the wind, not the engine. The dollar index has slipped to 98.32. You don't need a story to understand what that means for metals. A softer dollar is a tailwind. It makes dollar-priced commodities easier to bid up globally. It changes relative value. It invites allocations. And in a breakout, tailwinds matter because they reduce the fuel needed. Silver doesn't have to fight as hard to climb, so I'm not building a narrative around why the dollar is weak, I'm just respecting the chart fact. DXY down, metals up. momentum gets to run. The $110, $120 zone. Why it's the next logical stop. All right, the big question. After $100, where does this go? Once a major resistance breaks, price often runs to the next vacuum zone. That's where Fibonacci extensions and prior structural levels cluster. On this chart, that zone sits between $110 and $120. Think of it as the market's next negotiation table, not a guaranteed destination, but the next logical area where sellers will test the rally. Why is this zone so important for 2026? Because it's not just a technical line. It lines up with the narrative shift happening underneath the surface. Silver isn't being treated like a sleepy metal anymore. It's being treated like a strategic input. And that matters because strategic inputs don't get priced like collectibles. They get priced like necessities. The industrial pressure, solar plus AI. A structural bid. Now let's connect the chart to the real world, briefly and carefully. Industrial demand is not a rumor. Solar PV and AI infrastructure are both metal hungry. The solar build-out being discussed for 2026 is massive, around $665 in forecasts. AI data centers are also expanding, and silver shows up in the electrical backbone of modern systems. When industrial demand grows faster than supply, you don't get a gentle market. You get a market that reprices in steps, and those steps often look exactly like what we're seeing. Break, hold, sprint. So yes, we trade the chart. But we also understand why the chart is acting this way. The empty vault. Check. Watch the physical signals. Now, the part paper traders ignore until it's too late. Physical availability signals. I'm not going to throw scary words at you. Here's the practical takeaway. Watch inventory trends and delivery pressure metrics. When the market starts pushing $100, strain shows up quickly. If the system is comfortable, $100 is just a number. If the system is tight, $100 becomes a trigger, because entities that promise delivery scramble to secure it. So here's your checklist. Watch how price behaves after $100 prints. Watch spreads and premiums where you can. Watch whether pullbacks get instantly bought, because in a real squeeze environment, dips don't last. They get erased. The next 48 hours, 2 scenarios, 1 rule. Let's map the next 48 hours in 2 clean scenarios. Scenario A, continuation. Price holds above $97.22, breaks $99 or $40, tags $100, and then consolidates just under or just above $100. This is the healthiest path. It turns the round number into a platform. Scenario B, shakeout price taps near $99.40 or $100, triggers profit taking, and flushes back to retest 97.22s. If it holds, that retest is not bearish. It's confirmation. It's the market proving the floor. One rule decides which scenario is bullish. Do we hold above 97.22 on a retest? If yes, the trend remains in control. If no, then we reassess and wait for structure to rebuild. What to do if you're waiting, and what to do if you're in now? Let's get practical. If you're waiting for an entry, stop demanding perfection. In strong trends, you don't get perfect. You get good enough with a plan. Your plan could be scale in small instead of all at once. Use the floor at $97.22 as your line in the sand, and accept that the market may not revisit the 80s anytime soon. If you're already in, don't let noise shake you out of structure. Your job is to track supports and trail your risk intelligently. In a breakout, emotions scream at the worst times. They scream buy at the top of a candle and sell at the bottom of a pullback. So do the opposite. Buy structure, not excitement. Protect structure, not fear. The simple level map. Before we close, I want to lock the map into your memory. 97.22, first defense line, breakout floor, 99.40, final gate before $100, psychological magnet and battlefield, 93.64, key support zone that keeps the trend clean, 91.47, 200 SMA on 4H, long-term trend floor, $110, $120, next resistance cluster, magnet zone for 2026. Print that map in your mind, because in fast markets, clarity is profit. Here's the real update. This is not a random spike. This is a breakout with structure, momentum, and a tailwind. Silver didn't just touch a number, it changed the conversation. If you want, I can do a follow-up the moment $100 prints and we see whether it consolidates or snaps into the next leg. And if you're tracking this with me, drop one word in the comments, levels. That way I know you want these fast technical updates when the market moves. Stay sharp, stay patient, and don't let the chart outrun your plan. RSI plus volatility. How to read overbought properly. A lot of you will look at RSI and think, it's overbought, so it must drop. In a breakout, RSI can stay hot for longer than your patience can handle. Overbought isn't a sell signal by itself. It's a strength signal. The real tell is what happens on pullbacks. In healthy trends, RSI cools down while price holds higher lows. So if we dip from near $100 back toward $98 or 97.22s, and RSI resets while price stays above the floor, that's constructive. If RSI resets and price slices under 97.22, that's a failed breakout. Also watch volatility expansion. A true breakout expands range first, then compresses into a tight flag. Compression is the reload. Reload is what often launches the next leg. Volume. Without perfect data. Read the tape. Even if you don't have perfect spot volume, you can still read conviction. Ask 3 questions. Are candles closing near their highs? Are pullbacks shallow? Do bounces happen fast? If the answer is yes, demand is absorbing supply. That's why the hold above 97.22 matters more than any single candle. Why $110, $120 is a zone, not a magic number. The $110, $120 target is a cluster, not a prophecy. It's where multiple reference points stack, prior swing ranges, plus extension bands, plus the psychology of bigger numbers. Markets don't stop on a dime. They pause where orders cluster. So don't worship one exact price. Respect the zone. The dip playbook. How to enter without getting shaken out. 2 traps destroy people in strong trends. 1, waiting forever for the perfect dip. 2, buying the first red candle and panic selling the next one. A cleaner approach. Floor, 97.22. Invalidation, sustained closes below 97.22, not a 1-minute wick. Entries, scale in zones, not in one click. If price pulls back to the 98.20, 97.60 area and starts printing higher lows on the 15-minute, that's constructive. If it rips through 97.22 and starts closing below it on the 1 hour, you step back. No revenge trading. Alternative method, wait for 99.40 to break, then wait for a retest from above. If it holds, that can be cleaner than trying to catch a falling knife. The hold playbook. Stay in the trend, not in your feelings. If you're already in from lower levels, your job is not to predict every wiggle. Your job is to protect structure. Decide in advance. What level would make you reduce risk? What level would make you fully reassess? Because if you don't decide in advance, you'll decide at the worst moment, right when the market is designed to scare you out. When $100 prints, expect noise, not atop round numbers or battlefields. When $100 shows up, algorithms hunt stops, options flows get louder, and headlines multiply. That usually means bigger intraday swings, not necessarily a reversal. So instead of asking, is $100 the top? Ask the better question. Does price accept above $100 or reject below it? Acceptance looks like consolidation above, with quick dip buying. Rejection looks like repeated failures and closes back under 99.40, your 48-hour checklist. If you only do 3 things, do these. Set alerts at 99.40, 97.22, and 93.64. Watch the retest. Does 97.22 keep acting like concrete? Watch the slope. As long as the 4-hour 200 SMA keeps rising, the path of least resistance remains up. Clarity beats constant screen watching. Let the market come to your levels, then respond, not react. The psychology trap that wipes people out in fast breakouts, your brain tries to feel safe. It sells on the first scary pullback, then buys higher because it can't stand being left behind. That loop is how people lose money in bull markets. Flip it. You don't need to feel safe. You need to be systematic. Support first, momentum second, stories last. If the floor holds, you stay calm. If the floor breaks, you step aside without arguing with the chart. And remember, markets pay discipline, not genius, especially when the screen flashes $100.